Is it better now? Is it working now? Yes.
Working? Yep.
Yep. Shall I? Yeah. It's working? You can hear?
Ladies and gentlemen, the forum is about to start. Please take your seats.
You can hear?
At the World Bank, not that.
Good. I found your papers are not in order.
Good morning. Can you hear me? Good morning.
You're doing the opening?
Yes.
It works? Huh? It's fine. Okay.
Testing. That's right. Yeah.
Where are we
Just
supposed
keep
to
it
head to
simple.
now?
Well, I think we
Testing. Can you hear
can
me?
just sit
Testing.
around.
No.
Here. Huh?
So the figures on the follow for 10. Physical on the 18.
Hey Joe, I'm cleared. Where's the swap?
Your Honour, I'm not sure if you had a chance to review it clearly.
Have a nice day. You too.
Dollar cut in 100 spot, please.
At 100, 11.16.
Bismillah ar-Rahman ar-Rahim. Your Highness, Sheikh Maktoum bin Mohammed bin Rashid Al Maktoum, Deputy Ruler of Dubai and President of the DIFC. Excellencies, distinguished guests, ladies and gentlemen, good morning. On behalf of the Dubai International Financial Center, I'm delighted to welcome you all to the inaugural Global Financial Forum. We are pleased to have with us today some of the world's most influential thinkers, business leaders, and policymakers. To those of you who have traveled to Dubai from afar, I would like to extend a special welcome. I would also like to take this opportunity to thank all of you whom have contributed and will be contributing to today's event, namely our guest speakers and the economists. The global economy is changing around us at great pace. From new technologies to new regulations to new trade routes, the status quo is being disrupted at multiple fronts. We are seeing a number of regional economies diversifying and becoming less dependent on oil. The shift towards economic diversification was one that we witnessed in Dubai more than a decade ago, driven by the vision and leadership of His Highness Sheikh Mohammed bin Rashid Al Maktoum, Vice President and Prime Minister of the UAE and ruler of Dubai. It was this vision that saw Dubai as an emirate become a hub for trade, tourism, aviation, and of course, finance. And it is this vision that led to the creation of the Dubai International Financial Center. Initially established under the guidance of His Highness Sheikh Mohammed bin Rashid Al Maktoum, it is now the foresight of His Highness Sheikh Maktoum bin Mohammed bin Rashid Al Maktoum, Deputy Ruler of Dubai and President of the DIFC, that will enable us to develop the future of financial services in the region. We announced DIFC's 2024 strategy back in 2015. We continue to make excellent progress and are on track to achieve our performance metrics over having a combined workforce of 50,000 people and 1,000 regulated financial firms. Although DIFC is just 13 years old, we are ranked among the world's top 10 international financial centers. We are number one in the MEASA region with 463 financial firms and an ecosystem of over 1,750 companies. There is huge potential in the region we serve. And through the DIFC, we look to support the development of emerging markets in MEASA and to encourage greater trade flows through the South-South corridor, which stretches from Latin America through to Africa, India, Southeast Asia, and of course, China. Today, through a series of deep dive sessions, panel discussions, and fireside chats, we will explore geoeconomic, technological, and financial trends impacting the finance industry now and in the future. The three key themes of the Global Financial Forum are globalizing Gulf finance, emerging markets, and the future of finance. Our hope is that by the end of our day, together we will have a clearer picture of what the future of finance looks like. There is a new order that the global financial service industry needs to navigate. At a geo-economic level, new alliances are being forged, and new trade routes are reshaping the commercial landscape. Meanwhile, the rapid emergence of advanced technologies to all areas of finance is creating shifts never before seen in history. Companies and nations can no longer wait for new technology to come to them. They must be the ones driving change. If they don't, they will be left behind. DIFC, three independent bodies, DIFC Authority, our regulator, the Dubai Financial Services Authority, and our Justice Enforcement Authority, the Dispute Resolution Authority. We are working hard to promote growth through innovation. Collectively, they are encouraging and enabling our community to harness financial technology to enhance productivity and efficiency for the entire MEASA region. We look to give them the tools to create new markets and bring an even greater array of financial services to the entire MEASA region. On that note, I would like to share some news with you. It gives me great pleasure to announce that today we are launching a new $100 million fund to help establish, grow, and upscale startup and growth stage fintech firms, looking access to the MEASA markets. The fund will leverage the DIFC's fintech ecosystem, consisting of attractive experimental licenses, market-leading pricing, and collaborative spaces. As I mentioned, there is immense opportunity in the market, and this will be one more step toward shaping the future of finance in the region. With that, I invite you to view a short video that will provide more insight on this exciting new initiative. Thank you.
Governor, thank you very much. And Your Highness, ladies and gentlemen, good morning and welcome to the inaugural Global Financial Forum. We have a packed and enthralling, I hope, day in front of us to consider, as you'll have seen in your programs, three main themes, each of which at this stage I will divide into three sort of sub-questions of their own. The first being the Gulf, globalizing Gulf finance, which involves both the Gulf as a source of finance and investment around the world, and the Gulf as a destination for finance from outside the world and from its own residents. And thirdly, the question of Islamic finance. Where does that stand as a financial instrument? Secondly, we're going to look at emerging markets and ask whether a concept so broad it includes countries as diverse as China and India, even though they're neighbors, does it make sense? What are the prospects of the emerging markets as an asset class? And I'm joined as co-chair by Simon Cox, our emerging markets editor, who recently wrote a long report demolishing some of the myths and preconceptions around emerging markets. So I hope we have a chance to go into them as well. Thirdly, we will be looking at the future of finance, which very appropriate that we've had an important announcement about Fintech this morning, because Fintech obviously is a huge part of that future. And we'll have to ask, I think, is this time different? After all, for nearly 2 decades since the dot-com boom, we've been expecting financial technology to disrupt finance completely, to overturn it. And yet, looking at it 20 years on, some of the main pillars of finance are remarkably unscathed. Is this time different? Are we really seeing a revolution in finance? And alongside that, are we seeing a revolution in financial inclusion? Is fintech opening finance to the many unbanked, excluded from the financial system around the world? And thirdly, we will have one session looking particularly at blockchain. Again, a technology we are told will totally transform the world, transform the way the finance industry works. But is it perhaps being overhyped? I should also introduce my other co-moderator, Willem Marx. Are you here, Willem? He will be joining us. He will apparently be joining us later. But I also have some housekeeping announcements. You remember, I'm old enough, as probably some of you are, to remember when at this stage in proceedings, the moderator at a conference would ask you to make sure your phones are turned off. No such luck, I'm afraid. Please feel free to use your phones to. We'd encourage you to tweet your thoughts throughout the day using the hashtag Global Financial Forum. We would also ask you to download an app. This is called Attendee Hub. If you search in your app store for Attendee Hub and look for, once you've got there, the Global Financial Forum. That you can use to follow the program, to correspond with each other if you, for some reason, don't want to talk face-to-face, but also, importantly, for some polling questions that we'll be doing throughout the day, just to sense the mood of the room on some of the topics we're discussing. On another housekeeping note, I think you will also all have in your packs evaluation forms. This is where you get the chance to evaluate which sessions have been most useful, which moderators have been most accomplished, which speakers have been most interesting, and that is enormously helpful to the organizers in arranging future forums. The other general note I would make is please don't see this as us up here on the panel and you down there in the audience. The panelists will be encouraged to keep their remarks brief, pithy, to the point, and to have, as much as possible, a free-ranging discussion rather than a series of presentations. And that will be much enlivened by your input. Every session will allow time for question and answers from the floor, but please, if there's something that happens in the middle of a session that you really want urgently to respond to, try and attract the moderator's attention. So finally, I would like to say how grateful we are to host today's event under the patronage of His Highness Sheikh Maktoum bin Mohammed bin Rashid Al Maktoum, Deputy Ruler of Dubai, and of course, President of the Dubai International Financial Center. And we're very thankful to him for attending the first session. Thank you, Your Highness. And we will now move on to our first panel discussion. If I could invite my panelists to join me on the stage. This is a discussion on Gulf finance going global, where I will be joined by Mr. Hafez Ghanem, the Vice President, Middle East and North Africa of the World Bank. I'm sure you all have complete resumes, CVs in your packs, so you'll know Mr. Ghanem's distinguished career, bookings at the Food and Agriculture Organization, and so on. We also have Mr. Shahid Rasool, the CIO of Omnivest, one of the Middle East's largest publicly listed investment companies. Khaled Talhouni, the managing partner of Wamda Capital, a venture capital fund investing in tech-enabled companies in the Middle East. And Karim El Sol, the co-founder and CEO of Gulf Capital, a leading alternative asset and management firm. Welcome all. Thank you very much for joining us. If I might start with you, Hafiz, could you try and, in broad brush terms, paint a kind of picture of where the Gulf is now? I mean, we've seen a low oil price or relatively low oil price for some time now. How is that impacting the region as a whole?
Well, the whole region, the whole Arab region is impacted by low oil prices and also by political instability and civil strife in Yemen, Syria, Libya, and so on. Now, the low oil price, paradoxically, we always think of it as just impacting the oil exporters, but actually the oil importers in the region are also affected by the low oil price negatively because they depend a lot on investments from the Gulf and on remittances from the Gulf. So the decline in the oil price has implied that, especially for the GCC, that those countries that had what we call the twin surpluses, a fiscal surplus as well as a balance of payment surplus, now have turned into deficits. And that raises questions about what is the outlook for the future, how to deal with it. Now, I personally believe that one should look at this as an opportunity, that this decline in oil prices is an opportunity because it provides more of an impetus for policy changes, for transforming the Gulf economies towards more diversification and more job creation. And we see many countries moving in that direction. I mean, we are here in Dubai, and Dubai is probably a good example of how you can do diversification in the GCC region. But we see other countries, especially Saudi Arabia, for example, with the Vision 2030 and trying to transform the economy. Transformation would need to go in two directions. One is in terms of government revenues. Governments can no longer just depend on revenues from oil. They need also to raise other types of revenues, and we see GCC starting to introduce VAT, working on introduction of a VAT. And on the other side, also in terms of job creation and investments, we need investments outside of the oil sector, which, as a corollary, would be important also for job creation. We are a region here that is about 70% of the population is less than 30 years old, and you need to create jobs. And those jobs would have to be outside of the oil industry.
Diversification into what, though? I mean, which industries particularly excite you?
Well, there are different areas, and we see. I mean, when I talk to different leaders in the Gulf, they always talk about the financial sectors, financial services. The other industry is in terms of the logistics, some manufacturing industries, obviously, and of course all of the high-tech startups approaches. And we see a lot of success stories in the region. And actually, I think my fellow panelists are examples of those success stories in terms of what industries to develop and the creation of jobs and opportunities for young people in the region.
Well, let's ask them.
Yeah, I think...
Khalid, you wanted to butt in there.
Yeah, no, I think totally agree with what Hafiz is saying. I think there is as part of the diversification drive, I think there's a key need not just to kind of enter new sectors, but also think of the economy in a different way structurally. I think we need to think about a move away from a state-driven employment program towards kind of entrepreneurship and innovation, because within that framework, we're able to tell the 70% of the under 30s that you can take your economic destiny in your own hands. You need not wait for a government to seek employment. And I think that's a particularly interesting kind of paradigm shift for the region, and I think will be the key to the diversification effort.
But you invest specifically in tech-enabled companies. I mean, we've heard that Fintech is self-evidently an area of huge potential. Where else?
Well, I think for us, it's interesting. It's really hard to pin down particular sectors just because of how nascent the early stage technology landscape is and how quickly it changes. So we launched our current fund about 3 years ago. At the time of our first close, we thought, for example, we wouldn't invest in e-commerce. We thought it was too capital intensive. It's too difficult for us to get into. Fast forward 2-3 years later, and we're seeing a huge upsurge in e-commerce at the large horizontal level in the likes of Souq being acquired by Amazon, one of our early portfolio companies, but through to kind of very vertical, niche-focused e-commerce as well, and marketplaces of different types. So it's very difficult to kind of pin down particular sectors. The few areas we are interested in or have seen huge growth in is fintech, and really within fintech, addressing financial inclusion questions such as access to debt markets, capital markets for both individuals and SMEs. We think there's a huge underserved market for content on digital platforms. The region is one of the largest consumers of YouTube and Facebook in the world, by far, by a mile, actually. And that kind of denotes a huge interest in content and the lack of good short and long form video content. We're just beginning to see enterprise offerings for corporates on software as a service platforms, on cloud platforms. So really across the board, we're seeing an incredible explosion of opportunity across different sectors and a huge wave of young people wanting to get into that.
Shahid, you also have a ringside seat, if you like, in looking at how GCC investors are allocating capital. Let's start with outside the Gulf, internationally. Which countries and sectors are most appealing to them at the moment?
Thank you, Simon. You know, the two big pools of capital are sovereign wealth funds and large family offices. They are put together about $6 trillion plus. And this big money is essentially looking to diversify and also for growth. So, and that they're finding stability and preservation of capital in US and European markets in various sectors: financial services, industrials, technology, e-commerce, new technologies, and also they're focused on emerging markets, Far East, and other Latin America as well. So I think from now on, given what's been happening in the markets last 3 years, the economic slowdown because of oil and also the geopolitics. This big money intense focus is outside the region, outside GCC markets. Back to Khalid's point, I think also there's a significant interest locally, but that market is very small. The e-commerce, healthcare, education, they are growing very well in the entire MENA region, but the ticket size is very small. So they cannot absorb a lot of capital. So there are constraints to scalability as well. But I think if you look at the investment thesis for big investors, they still find opportunities locally because markets are depressed. They're down 30% last 3 years, and there's a valuation argument. But whether asset prices will go back to 2014 levels, that's another question as well, because oil may not go back to 90 or plus and sustain there. So there's a major reset for the GCC economies and sectors like banking, petrochemicals, telecoms, utilities, and others. So for large investors, we are looking to really diversify globally, primarily into new economy sectors.
Kevin, can I turn to you? I mean, I think your business, as I understand it, is partly globalizing GCC companies, GCC investors. How do you approach that?
Well, we've developed an interesting formula as a regional private equity firm. We've identified the regional companies and invested in them and helped them become global companies. And many of our companies based here in Dubai spill over into Asia, Africa, some into Europe. And we realize when we create global companies, we can grow them and sell them faster at a higher price and a higher return, essentially. And the other appeal for our investors, when you create global companies operating across emerging markets, you diversify away single country risk. So some countries go up, some go down. On average, you're okay, essentially. So we found that investing in companies out of the UAE and helping them grow globally has been a very successful recipe for our investors, essentially. So we tell them, when you come here, we're not just giving you Gulf exposure, we're giving you emerging market exposure. And in fact, 60% of the funds we've raised from abroad, from Asia, Europe, and the US, essentially. So we're managing to attract FDI into the region for investors willing and looking for that kind of growth.
Thank you very much. I'd just like to interrupt the session briefly to thank His Highness again for joining us and to allow him, please, to take his exit from the room. Thank you very much. Could I come back to you, Hafez, to pick up on these points? One message coming through is that local markets are capacity constrained, if you like, in their ability to absorb too much capital investment. Is that your perception from your vantage point as well?
No, I mean, from our vantage point working the World Bank, we see a lot of need for increased investment, especially in infrastructure. In power, in water, in transport. If you look around the region, we estimate that infrastructure investment needs in this region is about $100 billion a year. And as we were talking about the new finance, new sources of new financial instruments and how to finance projects, traditionally in our region, all of those investments were done by governments. And I think, and we see now increasingly, there is a change where more and more investments in infrastructure is done by the private sector or is done through public-private partnerships. That's extremely important for two reasons. One is that governments, as I started by saying, with the twin surpluses becoming twin deficits, do not have the resources to mobilize $100 billion of investments on their own. And the second, and probably even more important reason, is that we see that the quality of the projects, the efficiency of those investments are much better when they're done with the private sector rather than done by the government. And we have examples. Actually, if you look at the region, the Middle East and North Africa region, compared to the rest of the world, in terms of the role of the private sector in infrastructure and the role of public-private partnerships, it is the lowest in the world when we compare it to the size of the population. And that has to do with what you were talking about in terms of this is a region where we have been depending too much on government to create jobs, to invest in infrastructure, much more than other parts of the world. And this paradigm now is changing. And we see increasingly those kinds of investments that were in the past done by governments are now being done either wholly by the private sector or in private-public partnerships. I'll give you two examples. One of the actually most successful public-private partnerships in the region is the Queen Alia Airport in Amman, which is a huge investment done with the private sector. And it is one of the best functioning airports in the region. Give you a different example and which also indicates the importance, which explains why there are wasn't a lot of public-private partnerships in the past, and why things are changing. In Egypt, the energy sector was one of the most distorted sectors. Governments setting prices that are too low, making it impossible for a private person to invest and get a return. Now, with a change in policies there, we see we've been looking over the last few months just $25 billion of private investment going into the energy sector in Egypt. So this gives you an example of how the government regulations, how the whole framework governing certain sectors was impeding private investment in them, and how the governments in the region are changing and are moving forward. And that's an important shift in paradigm, and I think we will see more and more of those types of projects, of those types of partnerships, especially in the different infrastructure sectors.
Is this something you're coming across, Karim? I mean, you work a lot with SMEs. I mean, is this a totally different world for them, or some of them interested in partnerships with government?
Well, governments in the region are privatizing. You can see a number of IPOs. Like yesterday, ADNOC announced they're privatizing their fuel distribution stations. There are a number of other IPOs in the pipeline in Abu Dhabi from the government, over 50 privatizations in Saudi Arabia. So really, it's a question of financial needs. Governments need to raise money to plug the fiscal deficit. In the past, they wouldn't have considered these privatizations, but now they need to partner with the private sector, initially through IPOs, but you see more and more public-private partnerships, specifically in Saudi Arabia, in sectors like the airports, transportation, waste, and other sectors. So in a way, it's a financial need that's driving this public and private partnerships and these IPOs and privatizations. So it's coming, it's a reality, and they have to do it. The other thing that was worrying us is the lack of capital markets activity. If you look at the number of IPOs in the Gulf, there were $10 billion in 2014 raised. This year, $300 million were raised, nothing. And the IPO market was shut. I think with these government privatizations coming in Abu Dhabi, in Dubai, in Saudi Arabia, the capital markets are going to be reopened, and that's very exciting for the private sector. Finally, we can consider the IPO market as an avenue to raise capital or exit companies. So I feel next year will be a more exciting year where the capital markets will open up again, and there's a number of blockbuster privatizations coming to the region.
And a number of references have been made already to the changes in Saudi Arabia. I mean, how much is that dramatic transformation there sort of hanging over the region as a prospect and potentially, I suppose, a danger?
I think, it's creating positive pressure. Abu Dhabi wasn't looking at those privatization before, but when Saudi Aramco announced their IPO, suddenly the other government said, well, we should look at privatizations and IPOs and stimulating the economy. So it's a virtual circle, and it's definitely happening. I think everyone's taking a cue from Dubai, how it's diversified, and that's clearly on the mind of the leadership in Saudi and Abu Dhabi as well. So it's coming, it's real, it's happening.
Do you agree, Shahid?
No, I agree, because this is a slow-moving process. This public-private partnership with large investment programs, they will get implemented over the next 5 to 7 years and yield results in the next 7, 10, 15 years. But most of the investors, the private investors like ourselves, are looking for medium-term returns, 3 to 5 years, right? And that's where the disconnect is. Even for traditional private equity in the GCC, like Gulf Capital or Braj Capital, they tend to hold investments for about 5 years. And then they have their 3 or 4x. So duration matters here. But I think it's a slow-moving process, and the results will be at the back end.
Khalid, can I ask you where you see in the surrounding region where you see the best prospects? Is it within the Gulf itself, or is it in its neighboring countries?
Yeah, I think there was an earlier point about the region not being able to absorb enough capital. I think within our asset class, the early stage technology asset class, I think that's, I would disagree with that very strongly. I think, the region has a huge upswell in the number of very viable, sustainable, high growth, high impact technology companies that find it very difficult to raise capital because there is a lack of interest in investing in that early stage. So for our fund, for example, our anchor investor was the IFC, which is part of the World Bank. And while we're incredibly grateful for everything IFC has done for us, I mean, we would have preferred to attract local capital to invest with us locally, right? That would make a lot more sense. And just to give you a sense of the scale of opportunities that are emerging, in our first year of operation, we saw about 300 companies that are fit within our mandate, that are within the scope of what we do, backed by and run by solid entrepreneurs. In our second year, that grew to 700. In our third year, this year, we're looking at 1,200 companies. And if we start thinking about our pipeline for next year, just people we're pushing into meeting in January, we think the scale is just doubling every year. So there are incredible opportunities in the region.
But these are presumably mostly quite small ticket investments.
These are, these would fall within the range of what we call seed, which is investments up to $1 million, or round sizes up to $1 million, through to the $20-25 million Series B rounds. So they do kind of get into the range of where PE starts to get interested. So everywhere from $250K up to the 25 million is an incredibly underserved market. And what's interesting is a lot of local capital, either private wealth or sovereign capital, are huge investors in Silicon Valley, for example. Like they're some of the largest investors in the name brand funds in the Bay Area. But it is very difficult to unlock that capital locally. And so there is a bit of a disconnect around that we're trying to kind of help bridge in a way. So
are those companies here in Dubai, in GCC, or is it around the region?
So within what's interesting about the segments we operate in is these companies do not really recognize borders in any meaningful way, right? They recognize the region as one entity, one single market, even though as you move across these countries, you see there are kind of geographic and political boundaries. But you take the largest companies in the region, companies such as Careem, for example, it operates across the region.
Including Turkey, Pakistan?
Including Turkey and Pakistan. What's beginning to emerge is a wider geographic group anchored in Dubai as a regional hub, which includes the GCC, the Levant, Egypt, increasingly East Africa and Pakistan. And we're seeing technology companies scale across those markets as well, not recognizing the borders between them.
And Hafiz, how about in your business, if you like, development finance? Because one of the arguments one quite often hears as new development banks formed, China-led ones typically, is that the problem in big infrastructure projects is not so much a lack of available capital or sources of finance. It's a lack of projects that are truly bankable and have been worked out to the stage where they are ready to take capital.
Yeah. Well, I would partially disagree with this. There is a need for a lot of investment in this region, especially if you define the region broadly to include Pakistan, Egypt, and so. But even beyond that, there's a need for a lot of investment in infrastructure. So the needs are there. Now, where I would agree is that many of the projects or those needs have not been developed into bankable projects for two reasons. The first reason is that if governments are developing them, and we, from our experience, infrastructure projects run by the private sector are more efficient than ones run by the centralized bureaucracies and governments. So there is the efficiency issue. If you are preparing a project to be done by the central government, it will not be bankable as a project that you are preparing for, to be run by the private sector. The second reason that I alluded to when I gave the example of the investments in the energy sector in Egypt are government regulations. If you have government regulations that discourage investment, say, in the water sector because you're fixing the water prices too low, then the projects will not be bankable. And so what we see is that there is a need for, first of all, for governments to be open and to be trying to attract the private sector. There's a need to change the regulatory framework and the legal basis in many of our countries to make the projects bankable for the private sector, to make the projects attractive for the private sector. And then there's another point that I would like to mention quickly, which is the whole issue, I think Shahid alluded to it, is the whole issue of risk. Often those are long-term projects where often your customer is the sovereign, and so there is an issue of would private companies want to take this sovereign risk, and that's where an institution like ours can play a very useful role. We can play a useful role in trying to shift the risk by providing sovereign guarantees. By providing insurance against sovereign risk, which we do, our group does in different forms. So that's very. For example, we are supporting projects in the water sector in the West Bank, which is as risky as it can be from an investor perspective, but with the right instruments to shift the risk, you can get those investments to take place. So that is how I see this developing. There's a great need for investments. There is a great need also for a shift in paradigm away from governments and trying to do everything to a paradigm where governments work with the private sector. For this to succeed, you need to change in regulations and in the legal frameworks, and you need to put in place instruments also to deal with the issues of how to deal with the risk that the private sector might not be willing to undertake.
Karim, you wanted to come in?
I think we have a real issue in the region. It's very hard to attract global investors to the Gulf and the Middle East. We know this. We raised 60% of our money from abroad. It was easy raising money for the region when we're growing at 5, 6, 7%. This year, at least the Gulf is growing at 0.6%. The next 4 or 5 years, you're growing at 2%. That's below the world average. When you add the geopolitical risk and the instability and then the low growth, frankly, it's not very exciting. So we either need faster growth or more stability to attract global investors. If you look at FDIs into the region, they're down. They used to be 40, 50 billion. I think this year they were 18 billion, at least in the Gulf. FDI is down, and the sovereign wealth funds are exporting their capital abroad. We're sitting on $3 trillion in the region, and most of that is invested abroad because they see more growth and less risk abroad, essentially. So there is a disconnect here. We need to attract more capital to the region from the sovereign wealth funds and global investors. But for us to do that, we need more stability and higher growth, which we don't have today. So, and I'm already thinking about my next fundraise, how I'm going to explain that to global investors, why they should be looking at the region. And it's going to be a difficult sell.
Do you face a similar problem? I mean, low growth, political instability?
That's right. I just want to connect what Khalid and Karim said back to the point of the investment opportunity versus allocation of capital, both size and attractiveness. I fully agree with Khalid that the new sectors in the Middle East today, healthcare, education, e-commerce, fintech, logistics, they have completely disconnected from the traditional old economy sectors like banking, telecoms, industrials, petrochemicals. They are trading at a discount to book and at depressed valuations. And here the multiples are 20 to 30 times in the Middle East today. So these are new economy sectors doing very well, and they're going to grow over the long term. However, when you talk about allocation of capital, how much can you invest in MENA e-commerce, healthcare, education today, I think they will take a lot more capital over the next 5 to 7 years. They'll become bigger. Like the healthcare industry alone will be about $75 billion in the region in 4 or 5 years' time. However, when you talk about big capital, $500 billion regional capital, where it should go, it's not finding opportunities in the region. 80% of that is going out because of, as Kareem said, growth, diversification, and also stability, geopolitics. So I think the opportunity in the region today is twofold. One, the no-brainer is to go into new economy sectors, right? The ones we talked about. Second, you can still find opportunity in the old economy sector because they're depressed. They're down 30 to 40% in the last 3 years. So you could develop a portfolio across both, new economy and old economy sectors in the MENA region.
Khalid, it's a no-brainer, we've just been told your sector, so why is it so hard to find capital?
Yeah, I think, just responding to an earlier point, I think, yes, on a macro level, there are certain challenges, right? First, the geopolitical, the scepter of geopolitical instability, which in some way contributes to lower growth. But I think underpinning a lot of this, which is positive for us, is the need for diversification, this move away from the state being the main driver and engine of economic growth. And within that, that's where you can find very interesting opportunities within the economy and within the market. The fact that 70% of the population is under 30 and is looking for jobs and no one knows where those jobs are going to come from, that's not a hindrance, that's a massive opportunity for us to reform the structure of the economy away from like that kind of status-led engine of growth towards the individual driving that engine of growth. And within that, that's where the investment opportunities, I think, are. These are young people that want to consume content, they want to shop online, they want to converse with their friends on digital platforms. They think in a very, very different way. And I think catering to them and empowering them to launch their own businesses is where the opportunity is going to come from in the region. The only disconnect here, if there is any, is how do we get more local capital in a capital-deep geography to invest more locally, as opposed to having DFIs or kind of global capital invest here. Yeah. If the picture was so gloomy, you wouldn't see companies such as Amazon, which rarely does acquisitions outside of its key markets and on this scale, come and acquire Souq.com for $650 million. You wouldn't see Rakuten investing in Careem, the region's largest ride-sharing business, to the tune of $250 million. There are large opportunities in the region within this kind of quote-unquote new economy, digital economy sectors, and I think that's where the growth will come from, and that's where we need to encourage pools of capital to flow.
Simon, can I, because I thought Kareem gave a very pessimistic view of the region. And I'm much more optimistic than that. I think Khalid's view, we cannot say that growth is low, so we don't have opportunities to invest. It's actually investment that will drive. Growth is low because investment is low. And so what we need is to see how we can create the environment to bring in more investment and to get the higher growth. Yeah. I think that this is really the issue. And how can you do that? And how can you capitalize on this huge wealth of this young people? It's a very young region, very dynamic region.
Exactly.
So let me tell you.
Can I ask two questions? Okay, firstly, if you'd like to respond to this accusation on pessimism.
So it's not all
Secondly,
pessimistic.
If not here, where in the world do your investors see good?
So Gulf Capital, our firm, we're over 11 years old. We started investing in oil and gas, power, water, infrastructure, government-led sectors, and we've had to evolve over time. And the new oil today is the consumer, as Khalid says. That's what we're trying to mine, and we're following the consumer. Youngest population in the world, fastest growing population in the world, highest GDP per capita in the world, consumption growing at 10% per year over the last 10 years. Amazing growth statistics. So that's very exciting for us. The other thing that's very exciting is the new economy. We've invested over 500 million dirhams so far in new economy, and we're working on 500 million of additional new deals. 50% of our deal flow pipeline, even though we're a mature buyout firm, is in the tech space. And that shows these are companies that are 10 to 15 years old, that have ramped up, generate significant profitability, and now we're buying strategic stakes in them. So what you're seeing here is the evolvement of new sectors that we didn't have 10 years ago, like the new economy or the consumer, et cetera. So we have to evolve with the times. And we took our investment thesis that we did 10 years ago and we threw it out the window. We said we have to take a blank sheet of paper and start fresh. Yeah. Where are the opportunities? So we're very excited about sectors like logistics out of the region, healthcare, education, consumer, new economy. So, but a complete shift from where we started 10 years ago. And we have to. Otherwise, if you don't follow the new sectors and the growth, it's going to be very hard investing in the region. Yeah. So I guess I'm saying it's not the old traditional sectors. You have to rotate towards the new economy.
Shahid, where are you in this spectrum of optimism?
Yeah, absolutely agree. Actually, I'm a bit balanced in the sense that I'm very bullish on the new economy sectors, the one we talked about. But at the same time, as the economy grows in the next 10 years, then the financial services, energy downstream, they will also pick up with the overall economy. So if you find good value today in these sectors, because they are depressed so much, it's good to allocate some capital now at these valuations. And at the same time, you also move into, in a big way, to these new economy sectors. I mean, if you look at Tencent, which was founded like 20 years ago, e-commerce play, messaging in China, they are $500 billion market cap in 15 years. Same goes for Alibaba.
1.4 billion people.
Yeah, but here, as we talk about the big population here and the bigger circle, so I think these businesses could grow very big in the next 10 years. So that's a promise.
Thank you all very much. I can't see the clock, but I imagine we don't have that much time left. So I would like to throw it open to questions from the floor, if there are any. I believe that there are two already, and I believe there will be a mic available for those. So in the second row here, please. Could I ask you to introduce yourself and perhaps if it's directed to a particular panelist to say to whom?
Hi, my name is Sunil Malhotra. I'm the partner for B-Chain. We're a management consultancy firm looking at Industry 4.0 implications on fintech. The question is directed to the panel, not somebody in particular. And the question is about emerging technologies and the impact on venture capital firms themselves, in specific reference to blockchain and ICO. And the question is, are you as capital firms in a process of being disrupted?
Yeah, totally. So I don't think I'll have a job in 3 to 4 years' time. So I'm going to have to kind of reinvent myself in a different way. No, I think you're 100% spot on. It was actually something you're raising during the panel. So if you think about the private equity and venture capital industry at its kind of most simplest form, what are we really? You know, we are basically intermediaries between sources of capital and those that want to receive capital, right? Recipients of capital. If you think about within that kind of paradigm, I think you begin to see how, as intermediaries, we are the most easily disruptible part of this kind of industry, probably more so than other financial institutions. You know, the days of us as just pickers of good companies, we sit on our in our kind of ivory towers and say, you know, you're a good company, you're going to receive X amount, and we're going to take this much equity. I think those days are ending, partly because of the blockchain, partly because of kind of ICOs. I think ICOs at this point are a bit premature in changing the nature of funding, but for a variety of other reasons around that kind of intermediation point. That intermediation as funds is prevalent because the information is not available to the sources of capital, neither do they have an easy way to execute on the transactions. But between the advent of technology and technology firms like AngelList, which allow for signaling of what are good deals, plus emergent technologies such as blockchain and others, right? You start to see where, you know, us as PE firms or venture capital firms will become irrelevant very, very quickly. So I think the way we think about it is, and the way we've kind of positioned ourselves is we're not a traditional venture capital firm. We have a fund, right? And we're going to continue into a second fund and a third fund. But we also have an equally important ecosystem building platform where we look to serve entrepreneurs at different points in their journey in different ways. So we offer different services to entrepreneurs across the board. We offer mentorship programs, community events, workshops, seminars. We're soon to kind of put together more community-based programs. We do research for entrepreneurs. We offer them a whole suite of services with the idea of building up the ecosystem so that they are attracted to WAMDA, so that we can work with them in different ways and someday invest with them. I think in future, the nature of our industry is going to shift very significantly, such that we don't look like just funds anymore. The other big thing is obviously like value add. I think a lot of PE firms have this offering. I think more and more VC firms have this offering. But I think the way we're thinking about it is a lot of the growth in our headcount will come, and a lot of growth in our OPEX is in performing services for our portfolio companies. So hiring for the companies, attracting talent for the companies, having industry expertise in-house that we embed within our companies, not as advisors, but actually as implementers. So they go in. So we have a team of logistics experts, operations experts, marketing experts, technology and product people that we embed within our companies. And we tell our companies to say, okay, these are an extension of your team, use them as you see fit. And we're able to aggregate their costs across the portfolio because we carry it on behalf of the companies. So a combination of these different elements, I think, is what's going to allow us to evolve. But our evolution as an industry is fast coming.
In the interest of time, I won't ask Karim and Shahid if they're about to be disintermediated. I think there was another question back there. Because we only have a couple of minutes left, so this may well be the last question.
Good morning. Sadiq Farid from Smart Crowd, founder of Smart Crowd. We're actually part of the new economy, part of the Fintech Hive accelerator program sponsored by DIFC. Just a comment and a related question, and not to single out Karim over here. I think using the political instability as an easy scapegoat. Political instability is all over the world. In North America, we have Mr. Trump. In South America, we have sovereign problems. In Asia, we have China Sea problems. In Europe, we don't know what's going to happen with EU. If you look at South Asia, there's a lot of political instability in Pakistan, India, and so forth. But the opportunities are still there. I think what we didn't discuss in this panel is structural reforms needed to attract more capital, attract more population over here to take advantage of this new economy that's coming along. We're starting to see a lot of efforts, initiatives coming out of UAE, Dubai. We heard a few things coming out of Saudi over the last couple of weeks. What's your thoughts on that in terms of what sort of structural reforms do we need to attract and retain the wealth in this region and invest it in this region?
I'm afraid we really are running out of time, so maybe I could give each of our panelists the chance to answer in one sentence, one structural reform that's needed before we go on. Well, and thank you, by the way, for not mentioning Brexit. It's nice to be away from it.
No, actually, I'm not sure I agree with the premise of the question. I agree that structural reforms are very, very important, but actually what is the reason I'm optimistic is that we do see structural reforms taking place. We do see the changes in Saudi Arabia, for example, the whole regulatory reforms moving away from the over-dependence on government. You see the huge structural reforms in Egypt. And you're already seeing the results in terms of an increase in direct foreign investment and an increase in growth. So you're absolutely right that structural reforms are necessary to create the incentives, to create the climate for investment. And I do see a lot of changes taking place in the region. And that is, in a sense, that's why I'm optimistic. And that's why I keep saying that maybe the decline in oil prices is an opportunity. It's an opportunity for this region to change and to move away from an old model of development that has reached its limits.
My quick one will be, reforms are needed, but it's critical how you introduce them. We have seen some disruption in Saudi Arabia last couple of weeks, a new initiative. So I think Dubai, Abu Dhabi, UAE is the best role model for the rest of the region. How to modernize the economy, how to attract capital, and how to innovate. So I think let's use UAE as a model, and the rest of the GCC can just follow.
Yeah, I think, we can talk a lot about like structural reforms, but I think that the most critical change is really a change in mindset. And I think to quote Arif Naqvi, the founder of Abraj, I think this idea, or to paraphrase him very badly, the idea that, risk is inherent within our markets, within emerging markets, growth markets, or within the region, is kind of part of universally practiced hypocrisy, right? If you think about where the epicenter of the financial crisis in 2007, 2008, where did that come from? If you think about all the political instability going on to Brexit, through everything that's going on in the US, this instability is ubiquitous, right? It's part of where we are, and I think we needn't focus on that too much.
Karim.
I think structural reforms are coming. They're coming faster than you think. Governments are really intent on restructuring their economies. Nothing is sacred. If they're privatizing Saudi Aramco, everything else is fair game. Taxation is coming. Subsidies are being cut out. They're going to balance their budgets, reduce the fiscal deficit. If we manage to pull that off, in the end, we're all better off. And then you'll be able to attract capital to the region because you have stability, growth, and sound economies.
Karim, you just battered your image as a pessimist. I'm afraid we really are over time now, so I'd like to thank all our panelists very much.
Thank you, Simon. Thank you.
Hafiz Ghanem, thank you. Zahid, thank you. Khaled, thank you.
So much.
Karim, thank you so much. If I could ask our next panelists to come up, we're going to move on to a discussion of Islamic finance, and in the course of it, I'm going to change chairs so I can next time see the clock. But we have three distinguished panelists. First, Mohammed Damak from Standard & Poor's, as it used to be, S&P Global Ratings. Harry, thank you. You are S&P Global Ratings now, and Josh Crum, Chief Strategy Officer of Gold Money, a gold-based financial services company. Thank you, Josh. And Abdullah Al-Alwar. How do you do so? Please. Good to see you. Thank you very much. Islamic finance, as finance editor at The Economist, one of the proposals I get most often from correspondents, and including not at The Economist, is to write an article about the growth of Islamic finance in Bangladesh, Africa, wherever. I mean, and yet, if I could start with you, Mohammed, I mean, it looks almost in decline. Is that fair?
Thank you very much. I think with regards to the growth, 2017 was a difficult year for Islamic finance. And 2018 is also expected to be another difficult year for Islamic finance. If you look at the headline growth rate, we estimate it to be around 5% compared with double-digit growth of the last decade. And the reason is simple. Islamic finance is entrenched into the real economy. And just to give you a number, in 2018, the GCC countries are expected to deliver 1/3 of the growth they have delivered in 2012. So when your economy is slowing and when you have an industry that is well entrenched into the real economy, it's normal that this industry slows down. But then within Islamic finance, we've seen a couple of interesting trends. So that was true for the banking industry. For the sukuk market, the picture in 2016 was similar to what I portrayed, but in 2017 it was completely different in the sense that 2017 was a fantastic year for the sukuk. We've seen the volume of issuance growing by almost 50% year to date. In the GCC, we've seen the volume of issuance growing by almost 2 times compared with last year. And the reason is simple again, that's because this year issuers had time on their side. Because if I take you back to 2014, when the oil price started to decline, a lot of commentators at that time were expecting the volume of issuance of sukuk to increase dramatically. We've seen the increase in the issuance, but it was in the wrong market, it was in the conventional market, and that's because of the complexity related to sukuk issuance. So when you are a government and when your revenues are dropping and when you need to pay contractors and you need to pay the salaries and you're offered different solutions, one of them is to tap the sukuk market, it could take you a long time, and one of them is to issue bond, It's smooth. It has been tested. So in 2016, most of the issuers went to the bond market. 2017, we saw them coming back to the sukuk market. 2018 is less certain, and that's because we saw major operation happening in 2017, and we're uncertain if these operations will take place again in 2018.
Thank you very much. Abdullah Al-Awwah, from your seat as Chief Executive of the Dubai Islamic Development Center, do you share that perspective? How is the industry growing from your point of view?
Well, I think if we talk about the broader scope of the Islamic economy, so the Islamic finance pillar, if you will, or the sector is a key component of that. But if we look at the larger sectors that define what we refer to as Islamic economy sectors, I do think that it does have a potential to contribute, significantly to economic ecosystems at large. Statistics do show that. The fact of the matter is the size of Islamic economy sectors is growing year on year. As of end of 2016, the size of Islamic economy sectors was close to $8 trillion US, and it is growing. But one thing I would like to point out, which differentiates probably this sector and makes it unique and appealing not only for Muslim consumers but also non-Muslim consumers, is the fact about its investment culture. The principle that underlies the Islamic economy sectors and encourages that the investments that are made in a responsible manner. I think that defines the Islamic economy sector differently. It defines the Islamic finance pillar as well differently. It is evidenced through various statistics that we have seen. It's not a surprise that the world economy has lost 45% approximately of its value following the financial crisis. Now, if you maybe drill a little bit deeper, you will find out that perhaps it is not because of the fact that these investments, were made in emerging markets, or emerging countries. It probably has to do with the investment policies or the investment culture that was in place. The Islamic economy segments encourage institutions to make responsible investments. For example, I would rather invest in agriculture businesses in emerging, markets, emerging countries, amidst an uncertainty of the future of food security, as an example. That, to me, is a responsible investment versus investing in loans, that are made for people that are not able to pay back those loans. So the principle of investment, I think that's what makes Islamic economy sectors appealing.
So in a way, you're putting it into the broader context of whatever you like to call it, impact investing, socially responsible, sustainable investing. At this point, could I bring you in, Josh? Yeah. It might be helpful to everybody to explain why, as Chief Strategy Officer of a Toronto-listed gold-based financial services and tech company, why are you here?
Exactly. No, I think that was a great transition. So what we are is we essentially use a private blockchain to make gold-based savings and investment accessible as for two things. One is gold is a traditional asset, that sort of spans all income classes, all countries, all major religions. So gold is fundamentally part of the financial system globally still. But what we use is a blockchain to make it accessible for at the lowest cost. But I think more broadly, where we're headed is we are fundamentally we agree with the principles of Islamic finance. So we didn't get into this sector and spend time becoming Sharia compliant because we see this great market opportunity of new customers. We actually came here because we actually agree with the fundamental principles of Islamic finance. And so for us, it's using technology to be, I guess, what is essentially I'm probably not saying this right, but a wadiya, a safekeeping business. And so we are millennials using the newest technology with the oldest form of money and essentially the oldest form of banking.
Coming back to you, Mohammed, talking about the constraints on the growth. I mean, I assume one of the biggest remains standardization. I mean, classification of what qualifies as Sharia compliant, how things fit together.
Absolutely. And I think standardization covers two things. The first one is with regards to Sharia compliance, because today we still have instruments that are accepted as Sharia compliant in some jurisdictions, and that would be viewed as non-Sharia compliant in other jurisdictions. The second layer of standardization is on the legal documentation. Today, when you go and see a CFO of a company or a minister of finance and offer him different solutions, one of them is to issue sukuk, which would take much more time and sometimes could be a little bit more costly, especially if you wanted to put together a sukuk with profit and loss sharing. So naturally, people would go to the conventional markets because the documents are there. It's easy to do a bond compared with the sukuk. The good news is that today people understand the importance of standardization, and some of the standard-setting bodies, such as the Accounting and Auditing Organization for Islamic Financial Institutions or the Islamic Financial Services Board, are advocating for this standardization to happen. And it's going to happen. It's going to happen. It's no longer a choice. This is something that should happen in order to put the industry back on track for stronger growth.
I mean, in that context, and we discussed this a bit earlier, how much of a crisis for the industry as a whole is represented by the Dana Gas case? This is one where a company is trying to contest its repayment obligations because the bond, the sukuk, may no longer be Sharia compliant.
I cannot comment directly on the Dana Gas case because obviously we don't trade.
No, but I'm talking about its reverberations.
And also there's an ongoing court case, so I won't comment on the case specifically. However, what I can tell you is that this case, together with other events that the industry has experienced in the past, brought back standardization to the forefront of the debate. Dana Gas is different from what happened in 2007 when Sheikh Taqi Osmani came out in the Financial Times and said that more than 80% of the sukuk issued were not complied with Sharia. At that time, the market has stopped completely, and people went back to the drawing board and started to scratch their heads and try to find a solution in order to restart the sukuk market. We haven't seen that with the current case. We haven't seen a major slowdown of the volume of issuance. We haven't seen a major impact on the pricing of sukuk on the secondary market or even on the primary issuance. But again, today the issue in the sukuk market is that the legal documentation is complex, it's not standardized, and when everything is going well, no one wants an instrument with its name to be rated D or to default on the market. But when some companies starts to struggle or some companies experience some liquidity issues, and then all of a sudden you have someone that is coming and saying, hey guys, I have a solution for you. You will be able not to pay your investors, and this is legal. So investors won't have any recourse. And that would sound as music to the ears of any management of a company that is experiencing difficulties. But again, I think fundamentally, the most important takeaway is that standardization is no longer an option, and standardization needs to happen to put the Islamic finance industry back on track for stronger growth.
Abdullah, I know you see the Islamic economy as offering opportunities not just for sustainable investment, but for South-South financing. I mean, how much does this sort of issue, the issue of standardization, the doubt thrown up by the Dana Gas case, how much does that take away?
It is, I mean, there's no denying it's quite a crucial issue, and at the same time, it's not a new issue. I mean, Mohammed's point about the need to standardize, across the board and have a uniformity is, of course, I believe, every person's dream within that industry. The question is how likely it is to happen. I have maybe a different opinion about the subject as
Please,
a
we
whole.
like disagreement.
No, it's not that I disagree, of course. I believe the issue of standardization is quite important. However, I do believe it is not easy to achieve a full uniformity when it comes to standardized contracts, regulations, etc. And the simple reason for that is that whether we talk about a specific product within the Islamic finance industry or the broader Islamic economy, the transactions and the consumers do have some sort of a faith-based factor that comes into play. And when there is that element, you will always have the differences, of opinion. So having standards, I do not think having different standards to a certain extent is not really a bad thing. But what we do really need is, I think, harmonization of those standards. So you have different markets today in East Asia, in Malaysia, in Saudi Arabia, Turkey, and other jurisdictions. And the consumer base, within those markets are quite different. And they think differently. So having different standards is, in my opinion, acceptable. So as long as there is harmonization between those markets. So what we need to do is we need to establish a platform, I think, where those scholars talk to each other, have a dialogue, and maybe encourage institutions to have a blend of scholars that sit on their Sharia advisory boards rather than the Sharia advisory boards represented by only a specific, geographically specific, let's say, set of scholars. So that will encourage harmonization. And at the same time, I think that will encourage innovation of the Islamic finance products, passportability, you name it. I think that that could be the solution when it comes to standardization. And as a matter of fact, at the Dubai Islamic Economy Development Center, that's what we also advocate for, is harmonization of standards. That's why we would, participate in creating those platforms where initiatives can come up that actually target that harmonization.
Josh, as a Canadian-based company, but you are presumably borderless fintech. The world is your market. Where are most of your customers from?
Yeah, so we've, in the 3 years since we've started, we've signed up over 1 million users. We have clients in over 150 countries. And we have the vaults where we keep the gold are in sort of the 7 main financial clearing centers, including here in Dubai. And we really, again, we've got clients that sort of spread across all income classes, all faiths. So it's a very interesting model that it kind of brings the world together. And if we talk about financial technology, one of the oldest and most important financial technologies for this region was the gold dinar, and how that spread. Almost every throughout history. We talk about financial technology being a tool of cooperation. And most sovereign regions will have their own local systems of debt or their own local systems of currency. But how do you actually trade and how do you bridge these cultures? It's usually with some sort of trust element that allows to take someone's debt and move it over to another country. Well, the gold dinar was very important as a cross trading route. And if you look at technologies like Bitcoin, that's exactly what the principle of Bitcoin is supposed to be, is to try to create a global sort of trusted medium that can bridge all these different regions. So I think the parallels and the fact that the gold dinar came out of this region and now you have financial technology trying to mimic that original use is what we try to do with our platform and use that gold as payments globally.
And are you targeting or are you attracting people who would be investing in gold anyway, or are you, as it were, expanding the market through a new financially inclusive mechanism?
I think we're expanding the market because there's a lot of millennials that don't buy gold coins or don't buy 22 or 24 karat gold jewelry. They like things on their smartphone. And what we do is we create an accessibility layer that it's very easily, you can go between Bitcoin and gold or all the major currencies in gold. We've linked in PayPal and WeChat and Alipay and Visa and MasterCard. So all of the electronic ways to get in and out is really what we do. And if you look at the underbanked, particularly in many Muslim countries, I've heard statistics is up to 70% are underbanked or have not a lot of access to financial services. And is that because of compatibility or is it accessibility? And so we bring a product that we think is very accessible and also very compatible with Islamic principles.
Indeed, Mohammed, I suppose the biggest Islamic countries in terms of numbers of Muslims are Indonesia, India, Pakistan, Bangladesh. I mean, in all of them, Islamic finance is not that big. Right?
It's still work in progress. And again, for Islamic finance to succeed in a country, it has to demonstrate an economic added value. And the economic added value could be either diversification of investor base for Sukuk issuers. I think it's clear that issuers of Sukuk have more chance to attract investors that are interested in the Sharia-compliant aspect of the transaction. And when you look at some of the statistics, when you do a Sukuk, you have around 60% chance to attract investors from the GCC. So this is the first layer of economic added value. Second layer of economic added value is to focus on the development of the real economy, but that should happen in a competitive manner. So for a country where there is already a conventional industry, you cannot come and say, I'm the industry of Islamic finance, I'm better than conventional, but I'm a little bit more expensive. That might not be acceptable for some of the country. And finally, you need to have a proper regulatory environment in place in order to make sure that there is a level playing field between the conventional and the Islamic finance industry. And it takes time to put together the necessary regulation. And even at the global level today, we're still facing some difficulties, for example, when it comes to having instruments for liquidity management for the Islamic financial institutions, or the lack of high-quality liquid assets. You know that Basel III has introduced the liquidity coverage ratio and the net stable funding ratio, and what the liquidity coverage ratio says is that banks need to keep a certain amount of high-quality liquid assets in order to face outflows, and that's to avoid any potential pressure on the liquidity in case of downturn. The problem in Islamic finance is that there's no such high-quality liquid assets, and that's again, and where I agree with Abdullah, everyone has a role to play in a sense that, for example, to boost the offering of high-quality liquid assets, government-related entities, multilateral, can boost the volume of issuance of Sukuk in order to respond to this weakness, for example.
Abdullah, in my opening remarks and in the program here, we talked about three themes for the day, with fintech and future finance being somehow separate. But is that the way you see it with Islamic finances? Are they? How does fintech affect Islamic finance? Is it helpful, or is it a further constraint in terms of introducing compliant instruments?
No, quite significantly. I think it affects the growth of Islamic finance. At the end of the day, we cannot look at this pillar as a separate pillar, from the entire financial services ecosystem. It's a component. The Islamic finance, yes, albeit maybe a little bit, not only a little bit, but quite smaller than the conventional financial services universe, maybe around 1% of the size of the financial services universe. It is still a component. And therefore, innovation and continuous innovation is quite key. Fintech, obviously, is a key driver for the future of Islamic finance. We are also pleased to see that some of our stakeholders, such as the DIFC, have taken a leading role in that space. Within the DIFC Fintech Hive, dedicating a focus area for Islamic, fintechs as well. And I do believe that this particular segment will contribute, positively to the growth of the Islamic finance sector. However, I do have maybe an observation on Mohammed's earlier remark with regards to, the size of the industry. I think there is an opportunity today for the Islamic financial institutions to address, and not only address, but to reach out to the wider audience and consumers than just the Muslim consumers. We mentioned earlier the close synergy and similarity between the principles of Islamic finance and ethical investing and responsible, finance, and that's one way I feel that the institutions can go about it. They need to attract a wider audience. However, if we look at some examples, I do not think that is happening at the same wavelength that it should. Today you have global principles and guidelines and standards out there that define what ethical investments is, what responsible investment is, such as the UNPRI, for example. If we look at how many Islamic finance institutions have subscribed to the UNPRI, it's literally, there is literally none, maybe except for one that I know of that have subscribed to UNPRI. Although at the same time, we know that the principles are 95% similar to what the PRI suggests. So that's an example. We need to have institutions that could reach out to a wider audience than just Muslim consumers, because that type of audience actually believes in responsible investing and ethical investing. And in doing so, that is one way where the Islamic finance industry could grow and the institutions within that industry could grow.
I suppose one problem with that, with expanding the industry, is that many potential users are very poor, underbanked. I mean, does fintech offer an opportunity for including them, for reducing the scale?
I think so, and again, one is the accessibility, just the mobile phones and the way that we've had this increasingly blurry line between what is a communication platform and what is a finance platform. These lines are increasingly being erased, and so I think that's the technology is one part. But again, I want to return to this principles because I think this is actually one of the bigger opportunities. I'm a former Goldman Sachs banker, so I've been,
you didn't need to share that. It's okay, I was going to.
I've been accused of vampire squiddery. And we like to joke that there's, the two golden rules. Love your neighbor as yourself, and he who has the gold makes the rules. and I think the finance industry has been focusing a little bit on the latter one. But if you look at the generational change, this isn't this cuts across all regions. People are demanding a more equitable and a more just financial system. And so I think between the technology and the accessibility with mobile phones and the fact that even in OECD countries, we want a more just financial system. I think these principles of Islamic finance are incredibly important and an incredible opportunity for the region.
Mohammed, can I ask you where, from your vantage point, you see the biggest potential expansion for Islamic finance?
Just before that, maybe one comment on the fintech. I think in this part of the world, fintech will disrupt the payment industry and the money transfer industry. If you look at the structure of the population in the GCC, it's dominated by expat. And these expat every year sends back home around $100 billion. The average cost of sending money globally was estimated by the World Bank at 7%. The Sustainable Development Goals aim to bring this cost to around 3%. And this is where fintech could play a role, and this is where the fintech hive and the regulatory sandbox that have been developed here in Dubai and in Abu Dhabi would really help the growth of the industry. Now, on the future driver of the growth of the industry, I think Sustainable Development Goal is one of them. And I think if you put the Sustainable Development Goals on hand and put the 5 principles of Islamic finance on the other hand, you can see natural connection between the two. But the problem today is that we don't know how to get there. We don't know how to develop instruments to be able to achieve the Sustainable Development Goals and to contribute meaningfully to the financing of the Sustainable Development Goals through Islamic finance. And that's, again, is related to the lack of standardization. That's because all of us practitioners today in the industry are busy doing the regular transactions of sukuk, structuring sukuk for the people that structure sukuk. We do not structure sukuk, obviously, as a rating agency, but structuring sukuk for the Sharia scholars, looking at the transactions that they have looked at many times. So standardization, people always say standardization would kill innovation. I think it's the other way around. Standardization will encourage innovation because it would give back time to these people to devote to putting together the next generation of the instrument in Islamic finance.
Thank you very much. Could I ask our audience, if you haven't already done so, to download the Attendees Hub app to search for Global Financial Forum and to answer our two polling questions about Islamic finance. Firstly, how optimistic are you, having heard some of our discussion about it, about the future of the sector? And secondly, does your organization use Sharia-compliant instruments, or does it have plans to? I'd be very grateful if you could answer those in the next 5 minutes or so we can have some feedback at the end as to how much you have believed our panelists. But if I could come back to you, Abdullah, how much are you in competition with other centers here in Dubai? I mean, how much will, as the industry evolves, will there become one main Islamic finance center?
Okay, I get asked this question a lot.
Well, I waited.
Yeah, thank you. No, maybe I will provide a little bit of a background to answer that question, because when His Highness Sheikh Mohammed bin Rashid Al Maktoum, the UAE Vice President, Prime Minister and ruler of Dubai, announced his vision back in 2013 for Dubai to become the capital of the Islamic economy, that type of question also was raised quite a bit. And the answer was that the Islamic economy strategy for the Emirate of Dubai is not a replacement of the economic ecosystem. On the contrary, actually, it leverages from that economic ecosystem that exists within Dubai, and it complements it. So the strategy that was developed was to complement the existing ecosystem in Dubai, adding a layer of Islamic or economic, let's say, transactions that are compliant with the Sharia and attract a wider audience as well. That's the reason why the strategy was developed. And the same, in my opinion, applies to other jurisdictions. I do not believe the Islamic economy sectors will substitute or is there to replace existing or traditional ecosystems. They complement it. They are an additional means to create value add for one's economy. And to answer the question, yes, the center was created not to compete, obviously, with other centers here in Dubai and other initiatives. On the contrary, it works with them to achieve His Highness' vision. And an example is the organizers of today's and the hosts of today's forum, the DIFC, which is working also closely with us on certain initiatives that further the development of the Islamic economy. And we mentioned one, which is the Fintech hive and the focus on the Islamic finance sector. And that's the philosophy of our center. We work with the stakeholders in the government of Dubai and with the private sector to actually further that vision.
Thank you very much. I'd like to ask Mohammed to comment on that, but could we also bring a microphone to Dato Mohammed Rafiq Merikan in the front row here, Chief Executive of Maybank Islamic Bank here from Kuala Lumpur for his perspective. But first, Mohammed, how do you see this question of whether there will be one main Islamic finance center?
I think there's a place for everyone. And I think Dubai can be proud of what it has achieved. Dubai is today one of the major centers of Islamic finance. The Nasdaq Dubai is one of the major markets for listing sukuk. The Dubai Islamic Economy Center is contributing to the vision and to the reflection on how the industry could move forward. I don't see it as a matter of competition between the different places because there's so many things to do, and Islamic finance could do much more compared with what it's doing today. Today, the industry is $2 trillion, but it has the potential to reach much more in the future. And today, we're at a very interesting time because we're at a crossroad for the industry of Islamic finance. It's either we sit back, relax, and enjoy the 5% growth rate, which is the easy way, or we tell ourselves, no, Islamic finance can do much more. I talked about sustainable development goals. There's also infrastructure financing, and we talked earlier about infrastructure financing. There's many other sectors and economies where Islamic finance can play a much bigger role. So the hard way is to say, how do we get there? And we get there through standardization. We get there through more integration of the Islamic finance with the Islamic economy. We get there through universities offering more adequate quality of education to prepare the next generation of leaders in Islamic finance. So everyone has a role to play, and I think it's either we sit back and say, okay, that's fine, we're going to enjoy the 5% growth rate, or we're going to do much more and we can take the industry forward.
Okay, well, once again, please do vote. Go to the app, go to live polling, look for the Islamic economy session and answer the questions. And please, Dr. Rafiq, perhaps just a few words on how you see Malaysia fitting into this picture that we've been describing.
Thank you, Simon. Thank you for the question. Good morning, ladies and gentlemen. In terms of what we're seeing, especially in the space of Malaysia, as well as we have a presence in Indonesia, is the willingness of the government and the regulator to create an environment whereby Islamic finance can actually thrive. Because coming from a smaller base, coming from I suppose on the sidelines of the broader banking system, I think there must be a stronger push in creating the environment for Islamic finance to actually grow in a bigger way, right? Say for example, I commend the efforts by the DIFC, for example, in terms of encouraging the ecosystem to actually grow, because when it comes to halal trade, for example, the consumers are predominantly Muslims. But when it comes to determining the fate and the growth of that particular segment, I think we need to play a bigger role, right? That growth must sometimes come from we ourselves, individually as well as a grouping, to actually say when it comes to investing, we need to be Sharia compliant. When it comes to consumption of halal products, for example, we will drive the standards and dictate how the demand should be, right? Because we can talk about the unbankable portion of the Islamic population, which is quite high, 80%. But the question is, what role do we play to bring them on board when it comes to the inclusiveness agenda? So the experience that we had in Malaysia, for example, the customer base that we have is about 50-50. Those who go by their beliefs, Muslims, and those who don't go necessarily based on their beliefs, but based on fairer terms and pricing, which we make visible to them. So I think that there's still a lot more that can be done. I think probably in terms of the opportunity for growth in the Islamic banking sector, once the institutions reach a certain level of maturity, then they need to play a bigger role, either on a regional platform or on a global platform, to make sure that this messaging, this acceptance, this understanding about what Islamic banking represents becomes a differentiator, as opposed to something which mirrors or mimics the conventional banking system. Thank you.
I'd like to open this up to questions on the floor. You promised not to mention Brexit this time as well. Thank you very much, Dato.
I promise this will be my last one for the day. A lot of the innovation, especially in fintech, is inherently consistent with Sharia principles, the whole theme of inclusion, sharing economy, sharing of risk and reward. There's a lot of companies like Gold Money, Jack Bank out of Sweden that are inherently based on Sharia principles, but don't brand themselves as Sharia compliant. Do you feel Islamic finance has a branding problem? Just to give you an example, I don't know how relevant this is, but the moment your panel came up, half the room disappeared, right? Do we need an Elon Musk Islamic finance? And if so, Any suggestions?
Maybe I'll take that one. I like the way you said that because I totally agree. In fact, when we announced Sharia compliance out of Canada, we had clients leave our platform in total ignorance of what it means. And again, it's our principles are shared, and I thought that was it's something that we need to do a better job of. So I think we talked about technology and we talked about the principles. One other thing that's actually important that I haven't brought up yet is also the secular decline in real interest rates globally. And if you look at what was traditionally a safe haven asset that wasn't Sharia compliant, something like U.S. Treasuries, these assets are now paying less than the rate of inflation. So the question is that even a logical safe haven compared to hard assets and something like gold and the rise of, I would make the argument that even blockchain and things like Bitcoin are a revolt on a negative real interest rate economy. And I actually brought. So this is the world's newest money. This is a Bitcoin, and then I have the world's oldest money, gold, with me here as well. And fundamentally they're both something that's supposed to preserve wealth with negative real interest rates.
Thank you very much. I believe we have answers to the polling questions, which I'm having some difficulty reading. Let me come round. So to the first question is, does your organization, or this is the second question, use or have plans to use Sharia compliant financing in its package? Yes, 58%, which is pretty high. And on the question of how optimistic you are, I think I saw in Michelle, yes, that on the scale of 1 to 5, 60% are in the top two categories. So general optimism. You've all been very persuasive. Thank you very much. And thank you also, Dr. Rafiq, for your contribution. If I may just ask Dr. Rafiq one more question, if he could have the microphone back. So I just wanted to ask, you mentioned your business in Indonesia and the categories. My perception is that Indonesia, the take-up of Islamic finance has been, given the size of the Muslim population, relatively low. Am I wrong? Or?
It is about 5%, relatively low, but I think there are efforts to make it much broader. And in terms of I think back to the question of the level of banking penetration, it is fairly low. Quite a number are unbankable. And I think one of the things that we have committed to do is to make sure that there is greater financial inclusivity. We must make sure that there is an ability for us to support the SMEs, the micro sector, which at some point will become the engines of growth for the economy. So a lot more needs to be done, but the environment is quite key. In Malaysia, for example, the experience has been the environment that is created. There is an express wish by the government, by the players, to grow it beyond just what conventional growth is. And I see that in Dubai as well. There must be a strong statement. And in Indonesia, for example, I think it's coming to that. They are forming the institutions that will enable the growth of Islamic finance in Indonesia to actually grow in a bigger way, right? But there must be that courage, that bold statement to make sure that that is in place, right? So we do see that, yeah.
Dr. Rafiq, thank you very much. And I'm afraid we're out of time, so thank you to all my panelists. Thank you. Good job. Thanks very much.
Thank you very much.
Pleasure to be with you. Pleasure. Thank you. Thank you very much. And it's now time for me to hand over to my colleague Simon Cox and his for the forthcoming panel. So Simon will come up and introduce his panelists. And then this is financial reforms in emerging markets. Thank you. Thank you. Thank you.
Well, thanks very much, Simon. So my name is also Simon Cox. I'm the emerging markets editor for The Economist. I've been a journalist at the magazine for about 12 years. And in that time, the best piece of writing advice I ever got was be concrete. Be concrete. We talk a lot at The Economist about fundamental economic forces, deep economic principles, but it's always nice to have a few telling anecdotes, a few concrete particulars, perhaps a colourful fact or two. So in this session, we're going to try and be concrete. We're going to have 2 case studies of financial reform in 2 salient emerging markets, India and Kenya. They're both a fascinating pair because they're both well known for efforts to promote financial inclusion, and they've both recently had problems with banks lending excessively and having to deal with the consequences of that. We're going to start with India. India, a place where I used to be based as a Delhi correspondent. And like many of you, we've recently been reflecting on the 1-year anniversary of the election of President Donald Trump in America on November the 8th, 2016. Now, India may be the only country in the world where that was only the second most surprising, most divisive, most disruptive event to happen on that day. Because on November 8th, 2016 in India, they launched a remarkable economic experiment known as D Monetization. They removed from circulation high-value banknotes, which accounted for about 86% of the cash in circulation. It was an extraordinary, disruptive, surprising, and somewhat divisive event. We're going to talk about that and the other financial reforms India is undertaking with my first guest, who I'd like to invite to the stage now, Mr. Sumir Kanti Ghosh, who is Group Chief Economic Advisor for State Bank of India. Mr. Ghosh, please.
Companies like to hear.
Sorry about that. Mr. Ghosh, I mentioned that demonetization was a surprising event. To some people, it seemed impulsive, almost ill-prepared. What did you make of it?
See, before I answer your question on demonetization, let me just take a few minutes, digress, and put in place some of the reforms which India is taking and the link of it to demonetization. I mean, since May 2014, the Indian government, the NDA government, has actually unleashed a series of reforms to structurally transform the economy. And one of the primary objectives of these reforms is to formalize the economy, and because in India, a large part of the unorganized segment actually I think it's close to around, there are several estimates, but the number is significantly high. And that leads to enormous problems in terms of tax reforms, in terms of fiscal reforms, in terms of other reforms, in terms of financial exclusion. So all these actually come as a part of it. So what the government did, and I will mention a very few before I move on to demonetization, is that ever since the government took power in May 2014, it has actually taken a series of steps whereby it has tried to formalize the economy. Some of the results of those reforms has been significant. If I give you some examples, the first was actually opening accounts for the poor. This is specifically called the Jan Dhan accounts in the Indian context. And as of date, 300 million accounts have been opened, and which has now a balance close to US 11 billion. The second thing which the government has been doing is also trying to lend to the informal sector people. For example, these schemes are typically called mudra, whereby you try to handhold an artisan and extend him loans on the part of the banks. As of now, around 90 million loans has been around 77 million US loans have been extended to 90 billion units. So that's another significant number. And to put the things in another perspective, the government is also doing a lot of inclusion on the insurance schemes. These schemes are called Jan Suraksha schemes. As of now, these are again for the poor. As of now, around 140 million people have benefited from it. So this is basically the some of the ex-ante measures of the structural transformation of which demonetization has been a part. Now let me come to your point of demonetization. Yes, on November 8, 2016, we demonetized 87% of our legal tenders, and it was basically a huge exercise, and obviously there was some disruptions. All the markets were actually taken aback, and there has been a lot of writings on this demonetization. For example, in the last few days back, on completion of this 1 year, there was a plethora of writings on this demonetization. But to me, I mean, even if I appreciate that, yes, there has been some problems, there has been some cost associated with the exercise, I mean, there has been some significant benefits of this exercise. Very few of the benefits, if I just want to put on the table, as of today, I mean, for example, in terms of the tax reforms, a lot of numbers are floating around regarding the tax reforms. In the Indian context, if you take the regime from 2009 till 2014, on an average, around 50 lakh people were added to the income tax net every year. And fast forward to 2014 till March 2017, of which the latest data is available, every year around 77 lakh people is being added to the tax net. So,
I'm sorry, just to intervene. For those of you who aren't familiar, a lakh is a unit of 100,000.
Yes.
So
it's 7.7 million.
That's right.
So it is 5 million every year. Now it has increased to 7.7 billion. So the number is already 1.5 times. Then in terms of the other number is, in terms of the digital economy, I mean, if I look into the POS machine, basically the point of sale machines, whereby the transaction is made, if you look at the transaction, that was around US 8 billion on October 2016, just a month before the economy got demonetized. In December, the number shoot up to 14 billion. Today, this number is close to around 20 billion. So yes, it's less than the peak what was achieved in December, after 1 month after the demonetization, but today the number is still 50% higher than 8 billion as it was on October 2006. Then if I just take a minute and...
Well, if I could just intervene, just to explain for the members of our audience who don't follow India all that closely. So the logic was, you remove these high-value notes from circulation, you give people a certain number of months to bring those notes into the bank to have them deposited in their own account. And by doing that, you encourage the formalization of the economy by essentially forcing people to open bank accounts, to add to their formal bank accounts, or lose the value of their cash. Is that right?
Yes, exactly. I think the other argument, I mean, this is exactly what the government has been trying to do. It has been trying to bring more people into these accounts, and even after these exercise, there was a lot of accounts which was also, a lot of money also came into this, the Jan Dhan accounts, the accounts for the poor people. And to answer your question more precisely, there was also a lot of formalization in terms of a lot of money getting pumped into the mutual funds and the other. So there was a definite financialization of the savings also. So my sense is that if you look into the exercise of demonetization in proper perspective, there has been a lot of benefits in terms of the formalization, in terms of the increasing digitization, and most importantly, the share of small currency notes. As you know, in India, the legal tender, the maximum legal tender was actually, right now it is 2,000, but the share of the large currency was 54% in 2004. That number came down to 13% in 2016. Today, this number is close to 30%. And everywhere, if there is a large preponderance of larger currency, that actually begets a lot of unaccounted transaction. So these are some of the benefits of the demonetization. I think maybe right now it may be a little difficult to quantitatively identify what has been the benefits, but over a period of time, as we see more and people coming into the tax net, I think the benefits of that demonetization will begin to unfold.
It's possible I'm biased against demonetization because I had a number of 500 rupee banknotes left over from my travels in my sock drawer, which unfortunately I didn't have a chance to deposit. But so let's accept this argument that it was part of a broader effort to promote financial inclusion that included bank accounts for poor people, micro loans. Now that we've had some progress on those indicators, what kind of economic changes, what kind of social changes might we expect to see?
See, I'll tell you, I mean, there has been, I mean, we have been also doing a study. Being one of the largest bank in India, I mean, we opened around 20% of the Jan Dhan accounts. And so we had actually a lot of data. And believe me, we have been also doing a lot of in-house research in our bank. So what we did after the demonetization, what we have been doing right now, we picked up a random sample of our accounts. Around, say, 2 million accounts we picked up. And you believe me, we looked into the behavioral changes of the people in those places where most of the Jan Dhan accounts are open. For example, let me take the state of Uttar Pradesh and Bihar, which is one of the most popular states in the Indian context. We have found that there has been a significant behavioral change in the habits of the people. For example, people are now spending less money on intoxicants. They're spending more money on the medical expenditure. And also there is another parallel scheme which has been going on. I think around 20 million people have been benefited of free LPG cylinders connection, which is commonly called the Ujala scheme in India. That has also led to a lot of expenditure pruning on the fuel. So all in all, the behavioral changes in terms of a broader, say, spending on medical, less spending on intoxicants, and smoothing of the consumption expenditure are some of the benefits.
So if I could invite you to speculate, why do you think people are spending less on alcohol and intoxicants because of financial inclusion?
Yes, that is one of the reasons, because...
What would be the causes? Why? Can you explain that behavioral change?
See, I'll tell you one thing over here. I mean, if you look into the empirical evidence across worldwide, there has been a lot of several papers also where has seen that, people generally, when they accumulate money in the bank, they try to spend it more wisely. And I think that is one of the benefits of this exercise, and that is exactly what we are seeing over here. Not only this, if I just add a little far, go a little far and talk about the Mudra scheme, where most of the loans have gone to the women entrepreneurs. We are actually seeing a lot of women empowerment over there, because a lot of women in these states are now setting up shops in terms of, say, jewelry shops or artisan shops, so whereby they are actually providing employment. So there has been structural transformation on the one hand side of empowering these masses, and the other hand empowering these women through setting up, so giving them sources of income.
That's very interesting. Do we have any questions in the audience for Mr. Ghosh about these financial inclusion efforts in India? Well, if not, let me ask a question about the other big issue facing India's financial system, which is bad loans sitting on the balance sheets of banks and the efforts to first recognize these loans, then recapitalize the banks, and ultimately reform them so this doesn't happen again. Where do we stand in that sequence?
See, the good thing regarding the bank is that I think there has been some sort of asset quality issues with the Indian banks, and in the past couple of years. There could be several reasons for it. I am not getting into those reasons, but the good thing is that possibly this asset quality cycle is turning for the better. If we go by the results which have been announced by both the public and the private sector banks recently. But one thing I would like to point out over here is that, as you may be aware also, the government in the last 10 days, in the last week of October, announced a huge bank recapitalization scheme, basically whereby it will use bonds which are cash neutral. And I think that has been an excellent step. And if it is followed also with some of the bank reforms, there was recently, as I am in Dubai in the last 2 days, on 11th and 12th, there was a bank seminar in Delhi, whereby all the captains of the banks actually had converged to deliberate on how to also address the issue of reforms along with this bank recapitalization plan. So I'm sure that if these two are used together, the banking sector as in India has a lot of potential, and any financial system in the world whereby and Indian banks generally, whereby they lend so much in terms of the financial inclusion and other efforts. I think that is going to be a successful one if we take these bank reforms also together with the recapitalization plan which the government has issued in.
And can I ask about State Bank of India in particular? I mean, surely one of your great competitive strengths is that you have this vast network of retail branches, which makes you more accessible to people than other competitors. But if these financial inclusion efforts and digitization efforts succeed, won't that erode that source of competitive strength for you?
No, I don't think so, because I think as a bank, if you ask me specifically about State Bank of India, we have been the pioneers in this digital transformation. We have been the first bank of India of many kinds. I mean, if you talk about the core banking solution, if you talk about this financial inclusion efforts. In fact, we have been also the first banks to issue in using a completely digitalized platform. And given the fact that, our bank has been going digital, and there is also I mean, we have been also the first bank to introduce a lot of banks without any people interface. So these are actually called the in-touch branches, whereby you were supposed to keep in touch with the customers, but not through physical means, only through digital means. So there has been several initiatives on the digital front, and I think it's actually going to act to help the banks in understanding and improving their bottom line rather than eroding them.
Okay, Mr. Ghosh, thanks very much for your comments. And let me now hand over to the Kenyan example. Thank you very much.
Thank you.
Thank you. So I mentioned that India and Kenya make actually a very interesting comparative pair. Kenya's per capita GDP is somewhat less than India's, but actually its indicators on financial inclusion, particularly formal saving and borrowing, are actually somewhat better. To discuss how that was achieved, I'd like to invite my next guest to join me on the stage, Dr. Patrick Njoroge, who is governor of the Central Bank of Kenya since 2015. Dr. Njoroge. Thank you. So I believe in Kenya, the highest value banknote is 1,000 shillings. Any plans to demonetize it?
Not anytime soon. We still have a lot of people that are dependent on cash in hand. So, but we've also made a lot of progress in other, higher up the scale, as it were.
Right, right. Well, I mentioned that, if you look at the sort of comparative numbers, Kenya actually looks pretty good on financial inclusion for a country at its stage of development. Can you sort of explain how that happened?
Okay. So back in 2006, financial inclusion was something like 26%. 26% of our adults were included in the financial system. The last survey was done in 2016, and at that point, our number had increased to 75.3. 75.3. A remarkable change in terms of financial inclusion. This has happened largely due to the platforms that we've been using on digital transformation that has taken place in Kenya and indeed other parts of the world. One of the I assume there are people in the room that would also think about iPhone, which also came 10 years ago, but I think M-Pesa has done a lot in terms of improving our financial inclusion. So you can actually have transactions, transfer, person-to-person transfer, using your phone. And this has transformed our financial landscape. So people that were previously not included can, and they do have digital platforms. By the way, the penetration rate of mobile phones in Kenya is 88%. 88%. This compares to something like, in the rest of Africa, I think it's about 60%. But if you think of Europe, UK and US, it's about 20%. So in terms of penetration of mobile phone technology, it's way up there. So the point is that leveraging on the mobile devices, phones, we were able to provide a lot of the financial services on the platforms. And a lot of people that were previously excluded did come in and began to access financial services on their phone. I've been governor of the central bank for 2 years now, and not once have I stepped in a commercial bank to make a transaction. And I think that's the way it should be. All my transactions are on the phone.
And that's not because you sit where the source of all the money is. No.
That could be, but that's not the reason. Yes.
I mean, it's remarkable. You mentioned that the iPhone was introduced 10 years ago, and M-Pesa is as old as the iPhone. But to state the obvious, presumably people who were using M-Pesa were using it not on smartphones like that, but on much simpler devices.
That is correct. Much simpler devices, much more robust, things that have much longer life of their battery and things like that. And I think, in a sense, this is one of the things we'd want to see going forward. We'd want to see cheaper, more accessible phones or phone devices. So yes, for most of us, we can afford the iPhone, maybe not the iPhone 10. I don't know if anybody can afford that right away, but I think the point is we still have a significant number of people. Globally, there's still 2 billion people that are excluded from financial services. And in order to get to them, I think one of the key elements is the cost of the phone devices. So yes, I'm looking forward to the advent of a very cheap phone device that will actually allow even the poorest of our population services to financial services. And I think that will provide a huge impact in terms of growth, in terms of incomes, or for that matter also in terms of improving the livelihood of these 2 billion people that are still excluded from the financial services.
I mean, Dr. Ghosh mentioned some of the behavioral changes that financial inclusion has promoted. Have you seen any similar changes in Kenya?
Sure. First, I would say we have had there has been an increase in the number of people, or rather, there has been a number of people, a significant number of people have been lifted out of poverty. Mm-hmm. That, I think, is an important element, because at the end of the day, that is where we begin.
But is that through increased saving, increased access to borrowing? What is the mechanism?
It works two ways. First is that through the phone, I have access to a larger network of people. So I can borrow from them, borrow not formally, but I can transfer some money to me when I am in need and so forth. So in terms of you're having a wider pool of people and wider pool of a support pool. It's an insurance pool, if you want to think of it that way. That has really helped. And this, for instance, you think of people who are right at the edge of society or edge of, for instance, when a poor person is sick and there's no other way of, or their child is sick. They need some resources right away for medicine. So it is very important to actually get money right away. If you have to wait until the end of the week when you are paid, you have some problem. Mm-hmm. So in that sense, the pooling of resources in the network has been very helpful. That's one. Then the other things, for instance, it's allowed there has been a lot of, there has been improvement in micro lending. So for instance, we have micro loans and I put it differently, which is you can actually stop at a traffic light, and before it turns red, you have actually requested a loan and it has been disbursed. It's that quick.
How long are the traffic lights in Kenya?
I was going to say, in Kenya, when the traffic light stops, when it says red, you should not stop. Okay. But that's another issue. A problem in our driving culture, but that's another issue. But the point is, a lot of traders, a lot of fruit sellers have access to these micro loans on their phones. And they can borrow, they can save, they can borrow for their capital, running capital. And in a sense, this has opened new ways or new avenues for them. Because in the past, they didn't have access to banks. I mean, and their banking hours are completely different from when the banks are open. So it has really allowed that sort of improvement. And the other one, which is also very important, is savings. It's allowed some savings. And of course, there's actually we have also tried to improve that, because we have now put in place a new savings platform where you can borrow or you can buy government securities right from your mobile device. Okay. So this is for people who even own, or people who are on $5 a day income. They can actually buy government securities, invest in government securities from their mobile devices. I mean, that is transformational in terms of the investments, in terms of savings culture, and so forth. So it's really remarkable the change that this has actually provided. Just some very simple, or what now appears to be very simple platform has led to a complete transformation of I think, the way people behave in Kenya, and indeed the way people behave in other countries like this.
You mentioned it seems simple now. I mean, one problem you sometimes see with countries that adopted technology very early is that they get locked into the old model and find it difficult to update to the latest thing. Any dangers of that in Kenya?
The danger here is, there is that danger for sure, but I think we are conscious of it. And so we are working towards, let's say, not getting too locked into these things. Maybe we should backtrack a little. One of the things we did at the beginning, now looking back, we were not that, let's say, when we provided the appropriate licenses and approval for that first innovator, we were not conscious of the concerns that would come later, as they are now, of having interoperable systems.
Okay.
Now that is much more a problem or a concern in other jurisdictions. And other jurisdictions have learned from us. And actually, once they start, they make sure that all the players in this sector are very much interoperable. Now, we didn't have that concern because it was only one player that was coming in. So it was an academic issue, if you want to put it that way. However, of course, now we have to deal with it because we know the benefits of interoperability. If we had to do it again, would we do it different? And the answer that I give on this point is no. We would have done exactly the same because of the benefits that came from from putting in place this technology and indeed this financial innovation. So I think the point is we can deal with it going forward.
Okay.
And like everything else, you don't know the entire journey, but you do have a sense that, yes, you will overcome those obstacles and hurdles that will come as you go by if you have the right attitudes and things like that. And I think we have that.
Any questions from the audience for the governor, particularly about this M-Pesa scheme? There's a woman in the third or fourth row. A microphone's on its way to you. Thank you.
Dr. Njoroge, there is no question that M-Pesa has played a big role in enhancing financial inclusion in Kenya. That being said, there have been several other MFS platforms that have come after M-Pesa and not enjoyed the same success, whether we look at Kenya, Rwanda, Tanzania. I'd be curious to know from the central bank what gave M-Pesa that secret recipe for success, or what caused that success that the other platforms were not able to benefit from, as a first one. And the second part of that question, if I may, would be there's been talk about the banks coming up with a response to M-Pesa. And since it has been 10 years, and it has taken the banks 10 years to come to a response, what does the central bank see as the next steps towards financial inclusion after what we've seen so far with M-Pesa?
Those are two great questions. Would you mind telling us who's asking them?
Sorry. My name is Alia Jiwani from the DIFC, currently working on Fintech Hive.
Thank you.
Thank you. Oh, complicated questions. Thank you for the questions. First, the M-Pesa, yes, was the first platform to do this. And in that sense, I want to say that the central bank needed to be, let's say, we didn't have a playbook to follow. So what was clear is we saw the benefits if it worked, the benefits of the technology and the innovation. And in that sense, that is what drove us to finding a solution to make it work. At the beginning, we did not even have a law that would support this. And so we provided a sort of a no objection approval for this product, even though the laws had not been written. It's only later in 2013 did we write the laws that would actually support the innovation that had been around for 5 years. So it's kind of a bug. But during that time, we were monitoring. We adopted a test and learn approach. So we learned, we looked at the risks, and were assured ourselves that the risks would be managed in particular ways. And on that basis, we proceeded. Now, why haven't we seen other products coming in? I don't know about that. Actually, we've seen a lot of other products. I don't think they're as, let's say, as people don't talk too much about them, but they are there. I mentioned one product. Actually, I mentioned two products. I talked about these micro-lending products, of which there are two platforms. And there is a lot of very interesting work that is going on around that. I talked about the M-Akiba, which is investing in government securities for as little as $30, $30 US. So there are many other products that are coming in around it. Only that maybe M-Pesa was loud, and actually I don't like talking always about M-Pesa because it kind of waters down all the other products that are around there. However, just to finish on your second point, the products that are coming now, we have to be more conscious about the risks. The world is much more risky than it was, say, 10 years ago. And I think you know things like, for instance, cybersecurity issues, and a few other things like that. So we are much more conscious of the risks that some of these products bring. It's true there has been those that have accused us for being, let's say, not supporting innovation, Bitcoin, and things like that. Well, we are careful. We are careful. If you are the regulator, you need to be careful because there are certain risks that you do not want your economy to be exposed to, or you want to be sure that those risks are taken care of. So I think it's more that than anything else. But I think what is very clear is central bankers are very open to innovation, very open to innovation. There's no sense of stopping innovation. But we are also very conscious of the potential risks. And until those risks are dealt with in a sort of a fashion that we are comfortable with, we want to be a bit careful.
Well, we can't stop innovation, but we will have to stop this session, okay. Unfortunately, fascinating though it is. I mentioned at the beginning it's good to be concrete, but it's also good to draw some principles from the particulars. And I liked your point that in some ways back in 2007 it was a simpler time, the phones were more robust, the battery lasted longer, and we didn't have to worry so much about cybersecurity. It's interesting to reflect on the added risks that the new sophistication of our technology brings. Governor, thank you very much, and a round of applause.
Sure.
And we now have a coffee break until the next session. Thank you very much.